Joining us now is Truist Wealth Co-Chief Investment Officer Keith Lerner and Wells Fargo Investment Institute President Darrell Cronk. Good afternoon to you both. Keith, I'll start with you. We had a ferocious start to the year. What do you do now as an investor?
Well, great to be with you, Morgan. Now, our overall view is that we are strongly neutral. That doesn't sound too exciting, but this is in this post-pandemic world, a lot of the indicators that we're looking at is relatively mixed. So we're basically neutral against stocks, cash, and bonds. As we think about global asset allocation, we are maintaining our long-standing overweight to the U.S. markets, which outperformed in the first half. We think that's likely to continue. We do think there's a relative opportunity in the equal weight index. That index is only up about 5 or 6%. It had one of its largest underperformance relative to the S&P market cap that we've seen in the last 30 years. And then lastly, on the sector side, we upgraded tech in March. We're staying with tech and communications. And we also like, industrials as well.
Okay. Darrell, I want to get your thoughts. We just had Fed minutes, and the takeaway there is really, okay, 2 more rate hikes likely in the cards. Fed's not done, even if it's close to done. You take that, you couple it with this breakdown in UPS contract negotiations. We're going to get into the stock specifics around that a little bit later in the show, but it speaks to what we're seeing at a number of companies across the country right now is this tight labor market and the possibility of a wage price spiral, which is what the Fed is trying to avoid right now. So I do want to get your thoughts on this dynamic and what it means for markets if you see interest rates that have risen, thus the cost of capital has risen, and you've seen a low cost of employment and the costs associated with that now on the rise.
Yeah, good afternoon, Morgan. It's great to be with you. So it is important. I think UBS can be a barometer in the market. We don't think that the strike is imminent. We think today's, contract negotiation breakdown is probably just a breakdown in that. There's still, 26 days to go until the contract expires. Most of the non-pay issues have been negotiated already, so it's just really coming to a conclusion on pay. But your point's well taken. I mean, we saw the Fed meeting notes this afternoon, or the minutes this afternoon. The hawks are still in control, and the clear message coming out of those minutes is that the fear of the Fed is not an economic slowdown or recession. The fear is that inflation expectations become anchored, basically. And so I think that's what they're worried about, and wages play a big part in that. So if wages were to go higher, which it doesn't look like they are in the near term, they've been actually abating and coming down, that would be a real concern for the Fed.
What's so amazing to me, Keith, is the fact that you have had the S&P, you've had multiple expansion, despite the fact that we've seen ongoing rate hikes this year and turmoil in banks and not a contraction, but a slowing of growth in terms of earnings for the biggest companies as well. How do you see it now moving forward?
Yeah, it is right what you said. I mean, normally, if you had 3 rate hikes, which we had this year, and expecting more, you normally would expect multiples to likely contract or best be flat. But what you're seeing is, a difference below the surface. The average stock is around the same multiple from the beginning of the year. Most of the PE expansion we've seen in the headline market, as we all know, is from the tech sector as a whole. In our view, that tech sector premium will likely stay at a premium. And part of that is these are the companies that have greater earnings growth. And what changed starting in March is the earning trends for tech relative to the overall market started to improve. So we think the market multiple stays somewhat at a premium. I think we have a much more modest gain in the second half, driven by earnings growth as opposed to this PE expansion that we've seen in the first half.